Good afternoon, everybody, and welcome to ARC's web window in the second quarter of 2017. My name is Mark, and I will be the moderator of today's session. ARC's web window is a webinar series that has started in 2015, covering current industry hot topics each quarter. In this web window, my colleague Florian Gültner and Wendy Harding will give you an update on the second quarter business cycle of 2017. And now, without any further delay, I would like to pass over the word to my colleague Florian.
So my name is Florian Gültner. I'm Director of Research based in Munich. And I cover discrete topics mainly, but also responsible for economic research within ARC. And I'm with ARC for, I think, now 9 years. Today, we would like to talk about the business cycle update. We will actually go down from capital expenditures to machinery to automation, basically getting more and more to down on the electronics level, so to speak. First topic, as I said, is the development of capital expenditures and also the forecast. And then we go to machineries. And so, capital expenditures. Well, what we fundamentally do to create those fancy-looking charts is we actually add up the capital expenditures of end users. So we have all kinds of automotive companies there, food and beverage companies, oil and gas industries. We add up their capital expenditures. And as I tend to say, if you actually want to know the truth of how a company is doing, look at their figures in the annual and quarterly reports, because there no one is allowed to cheat or lie. So this is why we're doing that. The last data we have here is Q1 2017. By the time we did the charts, Q2 was not filed of enough companies to make a sample. Good, so you can see discrete industries are going down a little bit, but if you look at that from starting 2013 to now, it's actually a very, very positive development. We are now in, again, an uptick. We will see that later when we go into more detail into selected industries. But over the last, let's say, 2 years, discrete automation, close to consumer industries were the bright spot. They invested strongly in robotics, a lot of replacement of manual labor. That was really going well for automation suppliers as well as machine builders. In the middle, we have the hybrid industries. I have to be a little bit careful here because in 2015, we had a strong devaluation of the euro by roughly 15% or so. And this is mirrored here also because the index is actually based on US dollars because we build global indexes. But overall, the index it has its ups and downs, but in the long run, hybrid industries are also doing okay. As a rule of thumb, I always say, if people start to talk about food and beverage and pharmaceuticals as the bright spots of the market, we are typically in a down cycle because they tend to be very stable. Very simple reasons, we always have to eat. We are getting sick also independently of the business cycle. So this is typically rather stable. Now on the very right side, you see the dark side. The process industries, as you all know, we experience a big drop in oil prices. We had overcapacities in the steel market, overcapacity in a couple of mining markets. We had consolidation of mines. We have excess capacities in a couple of regional cement markets. That's important. Cement markets are regional. And overall, since 2013, there is no reason for joy in the process industry, basically, because it was all going downwards. Since around 2-3 quarters back, so mid to end of 2016, we see that this is stabilizing and slowly starting to catch up again. Well, that's the global picture, that's the helicopter view, and if you add those industries together, do the weighting right, you get basically a curve like this. So here in 2009, we have the recession. There was still loads of investment going on in the commodity sector, so that basically helped to counterbalance. You remember those high oil prices, they started around here. And one of them, we have the catch-up phase, good for the discrete industries. We have the negative exchange rates effects, and now we are leveling out in the process and expecting uptick again. In this process, so we collect the data here on our side. We also ask all our industry experts for automotive, aerospace, electronics, semiconductors, hybrid industries, oil and gas, etc., about their forecasts of their individual vertical markets. And then we created what you see here, which is the aggregated view, again, discrete, hybrid, and process industries, and how the future market will develop. Starting again from left to right, automotive and aerospace and defense were really drivers in 17 and 16. They were doing quite well. We expect that in the future, especially electronics and semiconductor will push the market really strongly, and robotics remain a hot topic. I'll come back to robotics a little bit later, but it will remain a hot topic. The boom is not over. Going back to the hybrid industries, we saw the slump here due to the exchange rates, etc. And then we actually see here the kickoff. Again, quite positive environment. India is looking good. China is looking very well. So the emerging markets invest again. In the developed world, we have basically a very stable demand. And we have shortening product life cycles, which assures a very, very consistent investment climate. So they are constantly investing in companies there. We have a special development in pharmaceuticals. So pharmaceuticals actually were always focused on R&D. That's their main concern, getting the research and development costs down and the time also down. They're now focusing increasingly on production costs as well. So this helps the investments climate and the process industries. I will talk a little bit more about the oil and gas later. We had a very excessive build up here in the rally of commodity prices. Then we had the collapse. I mentioned that again. We are having now already since mid-2016 increased due to spare part expenditure and the like. Seems like everyone got used to the oil price of $60 to $70 per barrel. And now we expect investments to pick up again. I always say what we observe is the hunger of the world for resources is not slowing down. It's not decreasing. We need iron ore. We need cement. We need all the different resources. So the demand is still there. Going a little bit more into living the helicopter view, going down a little bit. This case, automotive. So when you look at the bottom chart, you see that there is this little slowdown over the last 3 quarters in the automotive area. You all heard about those uncertainties about the diesel and the potential legal issues. You heard about the legal issues Volkswagen has in the United States. So there are some uncertainties there. The main trend is, however, very positive. It remains positive, especially for the short and midterm. That means the electrification has right now more positive effects than negative. So the purely electric car needs an easier production and will be lesser demanding Capex as well as in automation. But the hybrid is very, very complex. Therefore, this increased capital intensity of the automotive industry that we are observing right now. If we are very picky and want to find the hair in the soup, if you look at productivity and profitability KPIs of the automotive industry, there have been no significant increase since 2007, which is not a good thing. So EBIT per asset, EBIT per Capex, revenues per asset, they still remain rather constant, despite all the technological advancement we made. Having a look at the oil and gas sector, already mentioned the drop in oil price, now basically about to stabilize. On the right side, you see ARC's prediction of the future oil price. As we are analysts, we cannot agree on one single number, which is why we give you this range here as a scenario. So some of us actually are convinced it will be on the low side. Some of us are very much convinced of the high side, but this is the ARC consensus. It's not that far away from those forecasts of leading companies as well, such as the International Energy Agency. What was substantial, what happened over the last year and a half, is that the supply chain curve has changed, because the variable cost of shale gas and unconventional oil sources has gotten down significantly. So we now estimate that all the shale gas and fracking there are also price competitive at a level of $50 to $60 per barrel. Depends a little bit on the field, etc. But before it was significantly higher. As a result, oil and gas, I mentioned that on the bottom you see the short range. It's already picking up again in investment, and we really see a strong growth in the future. It seems weird, but actually oil and gas will be one of the drivers of the overall automation industry and capital expenditure markets in the next years. Biggest hit is right now on subsea, and they won't be really financially feasible for a long time until oil price gets down and then up and their costs get down. Refining has changed from huge investments to mainly brownfields extension, and they're very selective of their capital projects. So very careful investment right there. However, there was some investment in refining while oil prices dropped, which means they have more capital on hand. We also have a change in the owner-operator landscape in oil and gas, as the assets are not necessarily owned by the large global oil corporations, but by operator, owned and operated by different companies, which is more change in the customer type than it does have impact on the amount of capital expenditures. So, quick summary on the capital expenditures. 15 to 17 growth driven by close to consumer manufacturing. Investments in process and commodity sector picking up now and will drive the development from 17 onwards. China is still a factor of uncertainty. We currently have a strong uptick in China with pull effects on automation and capital goods market throughout the globe, but they remain at a level of uncertainty. We all heard China, the debt is a problem. Long-run trends are favorable towards automation, so there is no need why automation in the long run should suffer. However, we also see a significant slowdown, and we most likely won't experience those very strong growth rate years that we had between 2005 or 2002 and 2008 for more than 2 consecutive years in a row. One step further down to the plan for leaving the capital expenditure world, coming to machinery markets. Actually, with machinery, we have a very similar approach with Capex. We basically take the revenue of machinery companies, we add it up, and this is what comes out. This is very simplistic. It's actually quite complicated, believe me. But this is what you need to know about the methodology. This is what you know to interpret the chart here that we are showing. So the machinery index, again, we have revenue of machinery companies. We have more than 40 machinery companies in the sample. We cover really the machinery market globally. Then you see the rally we had here from 2002, 2003 onwards that I mentioned just a few seconds ago until 2008, with growth markets often double-digit, and for years and years in a row we have the dip, strong catch-up phase, and now really sideways movement till 2014. Here we have the exchange rates effect again, and now a strong uptick. Now, what's causing the uptick? Let's have a look at the more granular side of this index. Let's have a look at the different machinery segments. And what you see here, and this is the very good news about the current development. It's not just one machinery segment that's picking up, it's across the board. If you look at the very last column of these 6 charts, it's always pointing upwards. It's dark green, so to speak. But let's start with heavy machinery. This is the valley of tears we mentioned because of the oil price, and it's picking up again. We saw that again, and we saw that already on the oil and gas Capex. Packaging is strongly positive right now. Robotics We had the strong boom years here that everyone was talking about, the robotics hype with up to 30% growth rates year over year for a couple of quarters in a row. It seems like we've taken a short breath here, and now it's continuing. We expect that strong growth actually to continue. Plastics machinery, the strongest growing segment right now. Who would have thought that? Q1 2017 up 30%. I talked to my Chinese colleague. He says tire machines alone in China are up around 100%. So it's really a very strong market here. By the way, the big increase in plastics machinery that you see here was not 100%, let's say, business cycle driven. It was also opportunity driven. They had the opportunity to invest in machinery as the oil price then dropped, which is the main feedstock for plastics. So there were more cash at hand and many invested in machinery. And this is again, but this, let me see here, this is pushed by China and the recovering economies. Machine tools, also very ups and down, one of the most volatile markets you can imagine. We had a drop in the machine tool market in 2016, which also had to do with China, but also, and this is important, with the MTS show. MTS show is machine tools show in the US, and many of the North American users attend these shows, and they tend to be very, very cautious about investments prior to that show, and typically after that show, the investments pick up. As promised, we've talked about Capex, we've talked about machinery, and we're now going to talk about the automation markets. And for that, I'm gonna pass on to my colleague, Wendy Harding. Wendy, your turn.
Hello everybody. As Florian said, my name is Wendy Harding. I've been with ARC for just over a year. I'm in the European analyst team, and I'm based in the UK. And the areas that I look after really are my focus on is market modelling and forecasting, etc. So the section I'm going to present to you today is the automation markets index. Similar to the Capex index that Florian described, we do one for the automation markets, and this really is a similar type of process, but we focus on the automation vendors, so automation companies add up their information, and that is how we put together these charts and the information. Okay, so overall, as you can see in the charts on the left, automation has been stable since mid-2014. Drop in 2015, as we've already mentioned a lot of times, is due to exchange rate effects. Process automation, obviously, as we've discussed, and I'm sure you're all very well aware, there's been an awful lot of issues in the process automation side, oil and gas, mining, metals, etc., oversupply. So that has suffered quite a bit, but it's now leveling off since late 2016, and as already covered, that's looking more positive going forward. Discrete industries already showing an increase since mid last year, and that's looking a lot better going forward. In real terms, discrete automation did grow significantly, but it did take a little bit of a hit in 2016. But yeah, that, as we say, that is looking positive. So that's kind of the overall scenario. We also break it down into world areas or regions, and the way we do that is we base it on where the headquarters of the company, the automation company, is based. So the first one we're looking at here is where they're based in the Americas. So they have been more exposed to process automation, oil and gas market than most other regions. So obviously they've taken a hit in that area with all the issues of price per barrel, etc. that we've already covered. Contraction started in 2014, was actually stronger than back in 2009 in the crisis, the economic crisis. Psychologically, people always think of the 2009 one as being the worst ever in sort of recent memory, but actually for certain industries, not all, but certain industries, the 2014 one was actually quite a lot worse. However, saying that, we expect recovery because, as Florian just mentioned, the US machinery tool market is currently in pretty good shape, so that's looking good for the future. And also, shale gas is becoming much more price competitive with the way things have been going since 2014. The companies have had to become much more efficient and being able to supply the shale gas and in various items at a much lower price, so they're able to actually become more efficient and do more with less, so that's looking good. Then obviously there's also pull effects from China for the US and Americas. Okay, moving on to the next world area, which is Asia. Strong positive effects from 2016, basically through the appreciation of the Japanese yen, which a plus 10% increase towards the US dollar. So obviously that had quite an effect on the figures that we see here, or the charts that we see here. Strong impact from China again. Obviously China being in the Asia region, that has a strong impact on that area. India, it's quite a big focus just lately, but there's not an awful lot of Indian companies in our automation index because not many of them have their headquarters there, so the presence isn't that great. Mega trends do play a big part in this region. They continue to drive market development, and by that we mean things like mobility. There's a lot more people being able to move to different parts of the world and different regions to carry out their jobs, so that makes a difference. There's also globalization, where companies don't really just look to do business on their doorstep, but they're actually widening their net, obviously, a lot further into the rest of the world, and that's happening an awful lot in Asia, obviously. And urbanization, some of the countries that are not as developed are actually moving towards being in a much better place, and obviously there's a lot more spending going on there to fund that, so that helps as well. The next phase of growth will be especially in the discrete automation industries for replacement of labour, robotics, etc. Increasing quality, really where they're playing in more of a global market. They have to make sure that they reach the quality and standards and everything that are required in different world areas, so that should help with automation spending as well. And but it will affect the discrete automation more than process automation. And the last region we're going to look at is Europe. You can see here on the slides on the left, the movement has really gone sideways since 2014. While discrete industries, especially automotive, as Florian mentioned, have developed well, process automation, obviously in Europe, it suffered quite a bit, but it's now looking a lot more stable, so that's good news. Chemicals and fine chemicals, they're developing very well, so that's good industries to be involved in. Strong negative impact from the German power market due to overcapacities. So that has an effect on people investing in all sorts of equipment, from large DCSs down to decentralized, smaller PLCs, etc. So that would have an effect. And again, as we mentioned before, the China pull effects are expected to be strong. And that's already started really from late in 2016. So that's a movement that we're seeing as well. So that's the roundup of that section. I hand back to Florian. Thank you.
All right, thank you, Wendy. And that was actually our last content slide, so to speak. I just want to quickly wrap it up before we open the question and answer session. Well, we heard in discrete industries are currently doing very well, but they will slow down a little bit over the next month compared to process, which is really about to increase strongly. The industry seems to get used to the lower oil price, which is a good thing in terms of investment behavior, leaving the panic mode, coming down to forward-looking planning. What we see with those very high volatile markets and also the volatility in different directions, when we look at machine builder and automation suppliers, those are best conditions that have a very broad coverage. Yeah, next point, robotics boom is not over. It took a short break, but it will continue. And we currently have a very strong growth in China. It is not sustainable in the sense that we have double-digit growth for a couple of years in a row. It will wear out, and the special effects will wear out in 2018, and then we'll have single-digit growth again. But currently, we do not expect a hard, but rather a soft landing.
Thank you all for joining our web window once again. And if there are some further questions, you just can contact us. And I wish you a great day, and I hope you will join our upcoming web windows too. And I can only say bye-bye.
Bye, everyone. Thanks for joining.
Thank you. Bye.